Introduction to Fundamental Reporting, Part 1 of 3. Why Focus on Fundamentals? This is the first video of a three-part series. In this video, Part 1, we will discuss why it is important to focus on fundamentals and not fixate on volatile market prices. Many people think of stocks as nothing but squiggly lines that go up and down on charts. But focusing on price movements makes many investors nervous. It stirs emotions that make them buy and sell at the wrong times. Markets rise. Investors get confident. They buy more stocks. Markets fall. They get anxious. They sell their holdings. Their emotions fuel a buy high, sell low mentality, a well-documented phenomenon advisors and investors constantly struggle with. These emotions are so problematic that investing greats such as Warren Buffett and Jack Bogle regularly discuss their negative impact on investor performance. But looking beyond the squiggly lines, there are actual living, breathing companies making profits for their shareholders. And unlike volatile market prices, these fundamentals are quite stable. For example, the volatility of the S&P 500 index was 15% over the last 5 years, but the volatility of its fundamentals was just 2%. And during the credit crisis, the Dow Jones Industrial Average fell more than 40%, but its fundamentals were up almost 10%. It's an unfortunate fact of life. Market prices are influenced by numerous factors that generate excessive volatility: a hyperactive media, economic reports, central banks, analyst recommendations. The list goes on. This volatility disconnect is why it's so important to focus on fundamentals and not get caught up with market swings. However, you must be careful about which fundamentals you monitor. Company CEOs and Wall Street analysts often report figures that only tell part of the story. If you want the full story, please watch parts 2 and 3, where we explain how fundamental reporting provides a better, more comprehensive perspective of fundamental performance and why this perspective is so important.